So let's go ahead and do a explanation of essential question number 1. And this one's from November 16th, 2011. And what we're coping with right now is a marketing agency. So the first one is taking out a loan. We're keeping this nice and simple. This zero interest part that you're taking a look at right there is going to make it easier when you're bouncing down to go ahead and make a payment on a loan. So it's that bottom one right there. So what you're doing is that you are grabbing some cash, and that increase in cash is bounced off by an increase in liabilities. Remember that that balance sheet is an equation. Liabilities plus owner equity is always going to equal assets to you. At the same time, you got cash coming in, and anytime you see changes in cash, you got to figure out how that's going to affect the cash flow statement. In this case, you're borrowing, which means it's part of borrowing and lending, so you're seeing cash flow in, and that's what the increase is for from taking out that loan. The next item, which we'll do in blue, pay for some advertisements in the Oregonian to get the firm out there. Well, that's an increase in expenses because the Oregonian still charges. And that means that you're also going to see a decrease in net income. Now watch the sign conventions. Expenses are always positive numbers. That's the normal direction. And you have to make sure that you subtract those from the revenue. So you're going to see a decrease in net income. Also, whenever you see changes in net income, it's going to flow on over to the cash flow statements. So you'll see this decrease in cash from operations. So let's go ahead and switch to red for the next one. First customer comes in and pays you $10,000 up front to launch a marketing campaign for his brand. He pays you in advance. Now those advance payments, remember, those are always going to be liabilities to you. You owe somebody else money even though they gave you the money ahead of time. But it's balanced off by this increase in assets because you do have that cash available to you. Now technically what's going on is that they're lending you money. So you'll see an increase in cash from finance out of that one. And that's, again, anytime you see cash, try to account for it over here in the cash flow statement. So let's switch to the next question, which is to go ahead and make a payment on the loan. So with this one, what's going on is you're making a payment so you know that your cash is going away. At the same time, your liabilities are going down. Those guys balance each other out. And what's going to happen is you'll have a line in the cash flow statement in the finance section for that loan. And you'll see a decrease in cash over here, and that's you just paying off the principal on that loan. So let's go ahead and move on down to another color that I'm not exactly sure what to call it because I had a small box. Accept a local entrepreneur's offer to become a partner for $50,000. So what's going to go on is that you got all this extra cash coming in. At the same time, owner equity goes up, so you know that those balance out. Anytime you see owner equity changes, it's a good idea to remember that that stuff shows up in finance. Because cash is flowing in, you're going to see an increase in cash from finance. So let's go on to the next item, which we'll go ahead and make yellow. Purchase computer equipment and put it on the company card. Ooh, okay. So here's the equipment. So that's just some fixed assets going up. There's some liabilities going up, and at the same time, it looks like there's no cash changing hands, but really it's like two things going on. You're both taking out a loan and also buying assets. So cash is leaving because you paid for the equipment, but cash is also entering because you borrowed money. So it balances out to zero on the cash flow statement. Kind of an unusual thing, but that's the way it's depicted because when you pay off the credit card, you'll see decreases in cash from finance. So let's go ahead and move to purple. Kind of know what purple is. So there's the purple one. Your business receives a $10,000 award for commercial that you produced. Let's just go ahead and call that guy revenue, which produces net income increases, which produces increases in cash from operations. And the last one is that you have a party at the office. Not a good idea. To celebrate the prizes you won, unfortunately some of your tables and chairs are broken during the heated dance battle between your employees. Well, that's looking like an expense to me, and a decrease in net income, and a decrease in cash from operations. So it looks to be almost the same thing as taking out the advertisements in the Oregonian. So there's your explanation of essential question number 1 from November 16th, 2011.